Imagine you can print your own money. Over the last few years, the central banks and the governments have printed money like it was going out of style. Let me show you how is it that the government has mechanism in place that allows you to print your own money. Let's find out how. Don't forget, this is not financial advice, so please do your due diligence and your own research before you make any decision. Okay, so the main two topics we're going to cover are TFSAs and RRSP. So let's start with the TFSA and what does that mean and the characteristics of it. So before I even go further into the characteristic of each of one, it's important to understand that these acronyms are simply government programs. Just like when you make a charity donation, you will receive a receipt. That receipt has a number on it. That number allows that receipt to be cross-referenced to a database that will say, yeah, this is a legit receipt. This person contributed to a registered charity and therefore they're entitled to the tax credit that they're applying for. And so the same thing with TFSAs and RRSPs. They're programs that the bank need to report to the government, but those are not investment vehicles. You need either a checking account, a saving account, direct investment account to buy mutual funds, stocks, and things like that. The things that you invest in can either qualify or not qualify for the programs and get the tax credit when it's time to file your taxes. So now let's dive right into the characteristic of TFSA. So first of all, the most important aspect of the TFSA is the first two letters, tax credit. That's the big key here that we're going to be able to use later on to create our own money. Just like other programs, there's maximum contribution to TFSAs. As of 2023 was $6,000. It does carry forward. So someone that has not used their room over time, that room adds up every year. So as of 2023, the maximum contribution for someone that has not used their TFSA was $75,500. One thing that's interesting about TFSA also, the amount of money that you take out, if it's more than what you contributed, so if 1 year you can contribute $6,000, but you made money and you took out $10,000, the next year what resets is your $10,000 plus the new money. So somebody in that case in year 2 would have $16,000 to contribute, whereas someone that has not used anything would only have a maximum of $12,000 to contribute. It makes massive differences over the course of many years using this strategy we'll talk about. Those are the important aspects of the TFSA. There's no tax deduction or tax credit, but you don't get taxed on your gains neither. Now, RRSPs. The most important part of the RRSP is the registered, the first R. So it's registered, which means that it gives it a status where your tax on it is deferred. That means that when you contribute to an RRSP, the taxes that you've paid on the money that you're putting in there is going to be given back to you. If I earn a salary, I take $10,000 and I manage to put that in my RRSP, assuming my marginal tax bracket is, let's say, 30%. So that's the rate at which I'm paying income tax to the government, and I contributed $10,000 to my RRSP, I will be entitled to a tax deduction of $3,000 because the $10,000 is going to be used to reduce dollar for dollar the income I've earned that year. So by reducing my income of $10,000, I'm reducing the tax burden associated to that $10,000. And that's a tax deduction. And that's a very, very, very important part of the RRSP. Your contribution to your RRSP is a tax deduction. There's only a few things that qualify as tax deduction, and the RRSP being the most efficient one. But things like an RPP, which is a registered pension plan, so with your employer and all that, offers the same thing. So that would be equal with your RRSP. Childcare expenses, professional dues, moving expenses in certain cases, and in certain cases, interest on student loan. But of all of this, the one that can really be used to better your financial situation and use it as a tool for you to build your financial future is the TFSA RRSP relation. Why that's important in regards to your marginal tax bracket is because if you're working hard, you're earning like a good, decent income, and you're being taxed fairly high, like 30% or more, the taxes you'll get back from that contribution will be in function of the marginal tax bracket you are at the time of contribution. Tax being deferred, that means that throughout the time that this money is sitting in your RRSP, there's no tax implication. You're not getting taxed on the gains and so on and so forth. The government says we'll give you time to grow it, but when you go to take it out, then this is when we're going to talk about how much taxes you pay on it. Obviously, At that point, there's other programs that the government have in place, which are called Registered Retirement Income Fund, into which you would then move your capital. And then from there, you would start basically being your own employer and creating your own pension for yourself. And at that point, towards the end of your working life and all this, you should be able to position yourself in a better marginal tax bracket, which should be lower than at the time where you were working and earning lots. At that point, you should be able to pay less taxes on your dollar at the end of the cycle of growth in the RSP than you would if you didn't at the beginning. The other thing with RSPs, just like with TFSAs, you have maximum contribution, so 18% per year of your earned income up to a maximum of $29,210. Again, every year you don't use it, that accumulates. There's people right now listening to this that probably have hundreds of thousands of dollars worth of room and tax deduction that they could use, they could benefit of in tax planning that we just don't understand because it's not taught to us. So again, the most important thing with the RSP is that it's a tax deduction. So that money comes back to you. It's not just a tax credit where you reduce your tax burden to zero. It's a tax deduction, which means that whichever money is owed to you is sent on a check to you, paid back to you. And that's where the key of how we're going to print money for ourselves comes in. At this point, we know that we can invest in a TFSA, hopefully have a positive return on it. And then we also know that we have RRSPs where we can qualify for investment, where taxes that we have paid on income that we have earned will be given back to us so that we can better invest and grow our wealth, so that at the end, the government can get maybe less taxes but on a bigger chunk, right? So it kind of works out for everybody at the end. So here's how we use these two things together to print our own money. The money that we earn in a tax-free saving account is tax-free, which means that there was never taxes paid on that gain. Yes, how do I get money into the TFSA in the first place? It's a super good question, but we'll cover that in another video. Once we've made some gain in the TFSA, those gains were never taxed. We can then take them out of the TFSA without any tax burden and then contribute to our RRSP with that money. At the marginal tax bracket that you're at, the assumption is that you've paid taxes on it, but you haven't. So the government will send you the tax deduction that you'd be entitled in relation to that money. So again, if I make $10,000 in profit one year in my TFSA and I move that $10,000 to my RRSP, I get $3,000 back roughly at the 30% marginal tax bracket. Now that $3,000 never existed before. You literally printed it out of thin air. Now you can take that $3,000, you can do lots of things with it. You can pay debt, you can invest, you can send it back into your TFSA. Same thing. After a year, whatever money that $3,000 made, you can take the $3,000 plus its return, slide it back into your RRSP. Again, the $3,000 never existed to start with. You never paid taxes on it, neither. So even if it makes zero money for a full year and you just take the same $3,000 and you move it to your RRSP, and you're still at 30% tax bracket, you're getting another $1,000 coming to you. You take that $1,000, you slide it back in your TFSA, and you do the same thing. So now you do that every year, once a year at tax season. Well, 3,000, 1,000, and then the next year 300, and then the next year 100, and then so on and so forth. So now we have close to $4,500 guaranteed, risk-free, just by doing this. And every year you can start a new loop. So every year you can start one of these $4,500 loop with one movement of $10,000 into your RSP. So if you do that for 15 or 20 years in your life, we're talking easily like hundreds of thousands of dollars. This is basically how we can use TFSAs and RSPs, and how the dynamic between the two opens this loop that for Mr. and Mrs. Everybody like me and you, we can slowly but surely print a little bit of money every year and build our wealth and our financial future. So there you go. It's that simple, but it's not that easy at the same time. So I know it's a lot of information, lots of acronyms. Don't worry too much about it. It's all about start now using your TFSA for the year coming. And then when tax time comes in, then it's time to look at how you're going to move this money around and how you're going to start this free printing money loop for yourself. In short, you make gains out of your TFSA, you move those gains to your RSPs, you claim the tax deduction on it, you use that money, you put it back into the machine, and you start printing your own money just like the government. So thanks for being here and thanks for watching. We'll see you guys in the next video.